Here are the 5 big mistakes I see real estate investors make when they are looking to invest in short-term rentals. Number 1, they invest for the tax purposes only. Now, if you are a seasoned investor, you already know that the goal of investing is to make as much money as possible. You want to see the highest return on your investment as you can make. And taxes is just one piece of your overall investment picture. If you can make $1 million taxed at 40%, that's going to always be better than making $500,000 taxed at 5%. So always go for the investment that cash flows. Crunch the numbers and make sure that the investment actually makes sense. Don't just invest in a short-term rental because you heard there are tax incentives for it. Number 2, not properly tracking your material participation. One of the big benefits to investing in short-term rentals is that if you qualify for material participation, you can use the rental losses generated from things like accelerated depreciation to offset your other active income from things like W-2 or your business. However, something like this is heavily contested by the IRS, and if you ever get selected for audit, you will want to make sure you have a contemporaneous time log detailing and showing your material participation and time spent working at your rental. Remember, there are 7 tests to material participation, and you only need to meet one of them in order to qualify. And if you ever get selected for audit and you do not have this time log, you are at risk of having your entire deduction thrown out. Number 3, not understanding the difference between the land value and the building value. Now, whenever you're looking to use depreciation from your real estate to offset your income or increase your deductions, one of the most important things that you will want to understand is what is the land value versus the building value, because only the building can be depreciated and the land unfortunately cannot. So if you're doing some shopping for a short-term rental, one of the things you will want to keep in mind is what is that building versus land breakout. Generally, real estate that is closer to the water, especially properties on the beach, will have a higher land value than most properties. And so if you buy $1 million property on the beach, you very well could have half of that purchase price allocated strictly to land, and you won't be able to receive any depreciation benefits from that allocation to the land, only the building. Whereas if you look at a property in the Smoky Mountains, generally I tend to see higher building values out there, closer to like 75 or even 80% value, whereas the land will be 20 to 25% of the value of the purchase. Now, assuming the same purchase price of $1 million, you could have up to $750,000 of depreciable basis versus the building that you bought near the water, which has only $500,000. So be very mindful of where you are purchasing properties and understand that building to land ratio. Mistake number 4, doing a cost segregation after you do renovations to your property. Generally, if a cost segregation is going to be something that you are going to do to accelerate the depreciation, you will want to do that cost seg before you do any renovations. That way you can capture all of the deductions that come with the purchase of your property. Doing a cost seg after the renovations are done and you've already potentially removed some of the furniture or other different materials that may be inside the property, you could miss out on some deductions by doing the cost seg after the renos are done. So make sure that you do a cost seg before any renovations are done, and then after the renovations are done, maybe you could go back in and do another cost seg. But if you keep track of all your line items, maybe you can just hand that to your tax advisor and they can take care of it all for you. And mistake number 5 is potentially one of the biggest and most common mistakes I see, and that is not paying attention to the 14-day rule. The IRS says that if you use a rental for more than 14 days in a year or greater than 10% of all the days rented in the year, then you actually have a personal residence. And if you have a personal residence, you could be limited on the amount of deductions that you can take against your income. And if your strategy is to use bonus depreciation to offset your income, then this could be a big mistake. And it's a very common thing I see because a lot of people, especially short-term rental investors that go out and invest in these short-term rentals, they're usually buying a property that they themselves want to use for their family whenever they go on vacation. And there's nothing wrong with that, but just make sure you understand this rule and that if you stay in it over 14 days in a year, you are at risk of completely losing your deduction.